Hi, everyone, and welcome to IDB Global Federal Credit Union's Home Buying and Selling webinar. We are so excited to have you here with us today. My name is Marilyn Wagner. I'm the Director of Marketing for IDB Global FCU, and I'm just going to go through some housekeeping items first, and then I'm very privileged to be introducing our speaker today. First, just to let everybody know that we do have Q&A at the bottom of the screen. So those are the two little buttons at the bottom. Throughout the presentation, put your questions there and we will be sure to get them or answer them at the end of the presentation. We want to make sure that Josh is able to present all of his content. Additionally, this webinar is recorded. So in about 5 business days, you will receive an email from us with the content as well as the webinar recording itself in English. We do actually also send you a survey after if it really does help us understand what content, what products and services, what webinars are really useful to you. That way we can adjust them throughout the year. So please make sure it only takes about 1 minute to fill out that survey. Now, without further ado, I'd like to introduce Josh Waxman. He is a realtor that we work with very closely for numerous years here at the IDB Global Federal Credit Union. He is a platinum agent in Maryland, DC, and Virginia, and he really, really works hard to make sure that all of his clients' wishes, needs are met to make sure they're in the home of their dreams. So I don't want to lengthen this anymore. So Josh, I'm going to pass the baton to you, and we look forward to seeing everything you have to tell us about today.
Great. Thank you, Marilyn, for the introduction, and thank you to the attendees. I enjoy very much my long relationship with the Inter-American Development Bank, and I had said earlier to my colleagues here before we began that I really also enjoy going to the IDB and seeing everyone face to face, although in this day and age, we've all been very accustomed to the Zoom platform. And so I'm very happy to meet everyone in this new Zoom way of doing business. So nice to meet everyone, and thank you all for attending. As Marilyn mentioned, I will go through my presentation. Any questions that you have, put them in the Q&A field at the bottom, and then we will be able to begin with the slide presentation, begin with the Q&A after the slide presentation. So now I'm going to share my slides with you here to begin. Okay, terrific. So again, thank you for coming to the Inter-American Development Bank Home Buying and Selling Seminar. And I will begin with the buying process. So I've broken this into the 2 phases for you, home buying and home selling. And we're going to start with the home buying process. And I know from experience, lots of experience and years of experience in particular with people who come to the IDB, that when thinking about buying a home, most of the time what I've found is the first thing on people's mind is often, should they even buy at all, right? And the reason this becomes a big question, particularly for the IDB members, is because when you first come to the Washington, DC metropolitan area, you often don't know if this is going to be your permanent home. Is this going to be a long-term move? Maybe you've been given a 3-year assignment and you're very excited about it and eager to get busy with your work and to get busy learning this new wonderful area where we live, and you're not sure if you should rent or if you should buy. And I know that comes up quite often, and so I've made it the very first slide, the very first thing to talk about. So really quickly here, you can see there's advantages, right, and disadvantages to both. When you rent, you have a lot of flexibility, right? You're not tied into owning a property. Usually you're just tied into a lease, and leases can be, most of the time they're 12 months. Sometimes you can sign a 3-year lease. There are places that allow for a 6 months lease, depending on the property. Maybe you're uncertain and you need that flexibility. Maybe it's better financially. You might not have the money right away for a down payment. You're working on improving your credit score. There's another reason to rent too, is if you're completely unfamiliar with the Washington metropolitan area, you might want to take a few months just to acclimate yourself really with the community, the commute, where you like to shop, where you like to socialize when you're not working, etc. So it does give you some flexibility. When to buy? Well, right now, and I've been saying this for a couple of years, but I'm going to continue to say it until it's no longer the case. We have historically low interest rates, and I still use the term historically because if you were to look at a long-term graph, let's say, of interest rates, and I've looked at this graph going back, even into the 60s and earlier, and it spiked around 1979 or 80, but for the last few years, we have had, as you may know, incredibly low interest rates. People have been buying, and people that own have been refinancing. So it is a great time to get in. And so with all of these factors, and one thing to note is when you buy and sell, you've got closing costs. There are more closing costs when you sell than when you buy. And sometimes that's enough to push somebody in sort of one direction or another. So in factoring all this together, and there's no exact science because every unique family or individual has their own considerations, but I've sort of come up with a 5-year rule, if you will, that works really well for most IDB members who are new to the Washington, D.C. area. And the 5-year rule means if you are pretty confident that you are going to be leaving the area for good in less than 5 years, meaning 4 years or less, it might not be worth buying. It might be okay to rent. If you think you will own the property for 5 years or longer, doesn't mean you have to live there for the whole 5 years. Just own it, meaning you buy it, you live in it, maybe only for 3 years, and then after you move out, you continue to own it and you keep it as a rental property. I have a rental property myself in DC, so that I rent out where I used to live, and it's a nice investment to do if you wanted to diversify in that way. So it's not a matter of living there as your primary residence. It's more of a commitment, let's call it, to ownership. If you're going to be committed to owning a property for 5 years or longer, it's almost always better to buy than to rent. But it is a timing perspective to think about. And I know that comes up a lot with members of the IDB, particularly when they are new to the Washington, D.C. area. So let me move on. Now, this slide says step 1, get pre-approved for a loan. But I'm going to sort of correct my own slides here for a minute and just add something that will be at the end, which is we have a website, smartmove.com. And so really the first thing you need to do is register yourself with the SmartMove program so that way you can benefit from all of the options and financial incentives that are afforded to you by being a member of the IDB. So first thing to do is actually go to SmartMove, even if you're saying, oh, I might not be purchasing for another year or something like that. Register at smartmove.com just so you have that done in case you wanted to proceed forward. Then once you've done that, you want to talk to someone at the IDB Federal Credit Union. And I know everybody's virtual these days. If we were back in the office, I would say they're right there on the first floor at the IDB, but you can speak to them through Zoom or just picking up the telephone, I'm sure, and get pre-approved. So what that means is that they will vet your debt to income ratio, your credit worthiness, the amount you plan to put down, and decide based on the interest rates of today what they're comfortable giving you as a pre-approval letter. And then once you have that letter, that's enough to actually make an offer on a property. So it's really something necessary at the beginning because it gives you an idea of your budget, what you can afford on a home, what your comfort level is also to spend on a home. And then we would be able to write an offer should we find the perfect home. Without that, you can't really write an offer on a home. I certainly, if I was listing a property, wouldn't allow a client to accept an offer from a buyer that didn't have either a pre-approval letter for a loan, or if they were paying cash without a loan, they would have to show what we call proof of funds, right? So then once you have that pre-approval letter, so you start with the smartmove.com login, you get the pre-approval letter from the IDB Federal Credit Union. And then you begin starting with learning the market. So, the most important thing is, just like I was saying, and sometimes people want to rent for a little while just to acclimate themselves, but you want to learn where you want to live. There's all kinds of considerations, and it's hard for me to generalize with so many people because there's different considerations for different individuals or families. Sometimes schools play a role in this. Sometimes lifestyle plays a role in this, but you have to first, I believe, tailor your search to neighborhoods and then decide what you need. Is it, do you have a car? Do you have a lot of people in your family, etc.? And then we start to narrow things down sort of from there. Then, you work with us, one of the Smart Move, myself or one of my colleagues, to help sort of step you through the process of what happens. I will step you through this, I think, in the very next slide. In an abbreviated version, I put together a slide that will step us through the entire process, which is neat to see, and hopefully will be eye-opening if you've never purchased a home or never purchased a home in this area. And securing a loan, of course, actually comes towards the end of that process as you work with the IDB Credit Union and going through underwriting. So some of the things we do in this process, when we search for a home is, tailor the your knowledge base of the neighborhoods that you pick and the type of homes you pick, whether they're condominiums, single family homes, townhomes, etc., by making competitive market analysis, as we call them, CMAs, to help you understand market values for these different areas. Okay, so this slide is one I like to step through with everyone because it very quickly, like I said, it's a little bit of an abbreviated version, but it very quickly steps everyone through the entire home buying process from beginning to end. Okay, so step one, right there, initial consultation, all the way to 14, the settlement. So that's 14 is when I say you're opening a bottle of champagne and getting the keys to your home. And number one is when you just meet with myself or another colleague of mine and starting that process and the discussion about what you're looking for, what your hopes are, what makes sense for you even, and things of that sort. So one thing I want to just point out quickly before I step through each one is a question I get a lot from everyone. It might be on your mind, which is, hey, how long does this whole process take? Is this a short-term thing or a long-term thing? What should I expect? So here's the best way I will answer that, and it's sort of color-coded. Step 1 through step 6, there's no answer. I've literally gone from 1 to 6 in one day or 1 year. It could be different for everyone. Once you get to step 6, all the way to 14, that's already established because step 6 is an accepted contract and step 14 is the settlement date. And we have that in writing. We in the DC area, different than some other parts of the country, like New York, for example, we have fixed settlement dates. So when we write an offer, amongst the different things in the offer, including the price, maybe some contingencies, I'll talk about that in a minute, we have the settlement date. So that period of time is usually about 4 or 5 weeks. So once we get to an accepted offer, you can expect to be moving into your property usually in about 4 to 5 weeks. So now let's talk about the beginning. So we have our initial consultation, which might be on Zoom, and we talk about where you want to live, what you're looking for, et cetera, et cetera. You've got to get the mortgage application started. It's not getting through final underwriting, but you need, like I said in the other slide, you need the pre-approval letter to at least be able to make an offer on a home. We conduct our property search in the certain areas we've determined, and then we make an offer. Okay, most offers have certain contingencies, which are very important, and I'll try to gloss over them quickly right now. So most of the time we have a home inspection contingency, which you see in number 8. After we get the contract accepted, we're going to put our money in escrow, which is number 7. I'll talk about that in a second. We have a home inspection contingency, number 8. We have an appraisal contingency, number 9, and we have a final mortgage application. We've got a financing contingency also, That's number 10. So each of those 8, 9, and 10, we have contingencies for. What does that mean? Well, for example, if the home has an inspection that you're not comfortable with, maybe there's been structural issues, maybe there's been termite damage, maybe there's been water damage, maybe there's some other things that you don't feel comfortable, even if the seller is willing to, I'll fix them, I'll give you a credit, you have a right to walk away with no penalty. The appraisal, same thing. The appraiser goes out. Let's say you're buying a home for $500,000. The appraiser comes back at $475,000. What happens? Well, a number of things could happen. We could ask the seller to drop the price to $475,000. You could come up with a difference in cash of $25,000. You could meet in the middle, or you could void the contract with no penalty. It's your right to do if you have an appraisal contingency. Final mortgage application, similar, right? You're working with the IDB credit union, you're going through underwriting, you already had the pre-approval letter, but it's not the same as going through underwriting, and they find out something happened, your debt to income ratio, there was a car lease that somehow you forgot to mention, or you went out and spent a credit card, or there were more student loans, other things could happen too, there could be a lawsuit, etc., and you get a formal letter of denial. That's enough to void the contract. In each of these cases, I'm going to move back to number 7 right here. After your contract is accepted, you will put your initial earnest money deposit into escrow. What that means is the settlement attorney will open an escrow account that's titled, your purchase of this home. And it will be opened with your earnest money deposit. So let's say you're going to ultimately put $25,000 as a down payment. You might start out with an initial earnest money deposit of $10,000, which will be credited towards that $25,000 later. But there has to be money to back the accepted contract. And that is also something like the price that you put in the offer. So you're letting the seller know what you're planning on putting as an earnest money deposit. If you were buying a property for $1 million and you're putting $1,000 in escrow, doesn't sound like a very strong contract, right? So the earnest money deposit will be there in the escrow account towards your down payment. And then as you go through your contingencies, like I just said, 8, 9, and 10, you have a right to void the contract if any of those don't work out and get your earnest money deposit back. It's not at risk at that point. If you happen to be buying a property that is a condominium, a cooperative, or part of a homeowners association, there is yet another contingency that is by law in place, and that is a review period. So let's say hypothetically, you're buying a condominium in Washington, D.C. At a certain point after number 6, you're under contract, the seller has to deliver to you new updated condo resale package, or what we just sometimes call the condo docs, right? And the reason why, you have 3 business days once it's delivered, you sign, it's been delivered. Okay, now my clock on my 3 business days starts, and you can review it. And during that period of time, you can void the contract and get your earnest money deposit back for any reason. Why is this? Well, because DC and also Maryland and Virginia all recognize that in any shared living, condo, co-op, HOA, there are certain things about the property that a buyer couldn't possibly know by visiting the property. So if we were to see a condominium together and you said, wow, it's beautiful, I love it, it's just what I wanted, we don't know what the reserve funds look like. We don't know what the bylaws are. For example, there could be a rule capping rental at a very low number. Only 10% of the unit of all the units in the building can be rented out. And you're like, I might want to use it as investment later, and that's a concern. Or even things that you might not think of. Maybe there's a pet weight limit in the building of 35 pounds, and you have a St. Bernard. These things come up in real estate, and I've seen them all come up too. So you have a right by law to review all the rules, the financials. Maybe there's a special assessment coming up that you'd be on the hook to pay for, that you'd have to consider. So all of these things come up in real estate, and by law, you have a right to review that. So beyond the home inspection, beyond the appraisal contingency, beyond the mortgage approval contingency, if you're in a shared living situation, meaning a condo or co-op where there's common element, meaning the lobby and ownership of the building. You have a right to review all of that. Then at that process, you're getting your final loan commitment. We go through making sure you're getting insurance. We'll do a final inspection, a walkthrough of the property, and that might include bringing back the home inspector or not, depending on the inspection. So if there's an as-is inspection, meaning I just want to eliminate any big ticket items and we're not going to ask for any repairs, then obviously we would just go back and look at it without an inspector. If the original inspection had a list of 10 or 20 things that all had to be repaired, we might bring back the inspector to go through it and get a professional eye to make sure all the things were fixed properly. Usually we also collect receipts and things of that sort. So that's a very abbreviated version, sort of from beginning to end, running through what to expect in the home buying process. And I will move on to the home selling process here. And I know I'm moving quickly, and I'll leave some time for Q&A at the end as well. Okay, so understanding the market. Now, I will say this, although understanding the market is incredibly important when buying a home, it could be even possibly more important when selling a home. So that what I mentioned earlier in the competitive market analysis, it's something you might consider in buying a home, but it's absolutely mandatory in selling a home to really look at all these details, and we put them together and try to crunch the data in ways that's sort of easy to view and understand. Another thing that sometimes I like to do when selling a home is it's not a bad idea to go out, depending on where you live, and look at some of the comps too. When you buy a home, it's very common to see many different homes and visit them and say, oh, I like this one more, or this one's a great neighborhood, but it's not big enough, or it's whatever the situation is. But it's not a bad idea in a lesser scale to visit homes that are already on the market for sale in your area to get a sense of the competition. People that might be coming to look at my house to buy might also be coming to look at that. So doing the competitive market analysis, and I have it listed here at step 2, and understanding the market, just talking to me and getting my advice and coming with me to see properties and reviewing the CMA together should give you a good sense of market value. The market's been doing very well. I'm going to talk about that in a couple more slides, but you don't want to get into the position of overpricing your house, because one of the factors that most buyers look at is the days on the market. If something's just came on the market yesterday and you like it, well, you might have to move quickly and give a very competitive offer. If something's been on the market for 90, 120, 150 days, well, it's probably overpriced. I think that's pretty obvious. Okay, listing a property. So what we do in listing the property, and this is an incredibly glossed over version, I'm sure you can appreciate, but there's a lot of steps to do this. Some of it is understanding the market value, and then some of it is just prepping your home for sale, because you want to showcase your home in the best light. So we might come through and do some level of decluttering. We might do some level of minor fix-ups, whether that's paint, carpet, things of that sort. We might come through and stage a property. All of these things we do, and we do it based on the need of the particular home, what seems to make the most sense for that home in the particular market environment. And then when we market the home, of course, these days, the internet is really the place to showcase homes. But we do a lot of different things, not just internet-based. It's found, I think, about 50, just over 50% of homes, 51 or 52% are found by buyers looking on the internet. The next biggest phase is about 30% of buyers agents bringing a home to someone's attention. So we focus in these different areas mostly, and a lot of other areas too. Of course, our network is very international as well. Okay, this slide I put together because, like the first slide with renting or buying, when it comes to home buying, I find with a lot of people or members at the Inter-American Development Bank that capital gains and FERPTA here are things that are interesting and I've gotten questions about in the past. So I wanted to kind of talk about this, and I put together what I think is kind of an easy to understand slide. So let me first kind of start and talk about what capital gains is and how you can avoid it. So one thing to note is even if your income is in a tax exempt status, you are not exempt from capital gains. What is capital gains? Well, let's say you bought a property 25 years ago for $500,000 and you are selling it today for $1 million. That means you have a $500,000 difference between the two, and the IRS will want to tax you on that $500,000, right? And you're not exempt regardless of your income tax status. However, that's not to say you're going to end up paying any taxes in capital gains at all, right? So let's look at this. If you are a single person, in that example I just made, of that $500,000 difference, if you're living in the house for 2 of the past 5 years as your primary residence, you are exempt for $250,000. So that 500 number, if you're living there, not even now, but at least 2 of the last 5 years, will become only $250,000, right? If it is owned, if being the house that you're selling is owned by a married couple, living there as your primary residence for 2 out of the last 5 years, you will be exempt for $500,000. So in that case, your capital gains taxable amount would be 0, up to $500,000 if a married couple is living in the house as their primary residence for 2 out of the last 5 years. Okay, let's say you bought the house for $500,000 and you're now selling it for $1.5 million. Okay, you're a married couple, so we know we take of that $1 million difference, we take $5,000 right off the top. So now we're only taking $500,000. Okay, but still you're not going to pay on $500,000 because you have capital improvements. What does that mean? Well, anything you've ever done to the house in the 20 years that you've owned it that have made it a better house. Maybe it's a better house today than it was 20 years ago. Maybe it has a newer kitchen. Maybe it has a new roof. Maybe you've upgraded the electrical. Maybe you've added an addition. So you take the $500,000 off the top because you're a primary resident, married couple living in the house. Then you deduct capital gain, capital improvements. Then you maybe you had to spend money painting it, fixing it up, doing other things to get it sold, right? So you can subtract that as well. So by the time you're done, you bought the house for $500,000, you're selling it for $1.5 million. You've taken $500,000 off the top, primary resident, married couple. You've taken the next $500,000, you might have knocked that down to $250,000 or $200,000. And that's what you're paying capital gains on, which is usually about 15% or so of whatever's left over. So if you had to pay, in that case, about $30,000 of capital gains on a house you bought for $500,000 and you're selling for $1.5 million, wouldn't really be the end of the world in that case, because you're only paying capital gains at all if you're making a lot of money, frankly. So that's good. Now let me talk about the Foreign Investment in Real Property Tax Act, which has been around for about 40 years. What happened was there were investors in real estate, often not even living in as their primary residence, and they would sell a property and then they would just leave. They would say, okay, I'm done. I'm not an American citizen. I'm not coming back to this country. I'm not going to pay capital gains. And frankly, I don't care. And they could get away with it, right? And so the IRS wanted to make sure they were collecting money. So this law was passed about 40 years ago. And what it said was, we are going to collect money off the top, not off the difference in capital gains from what you bought to what you sold. We're going to collect money right off the top and take it right from settlement to the IRS. And then when you file taxes here the next year, even if you're not a citizen, but you file taxes here, you can then get it all back. You can show us, I live there as my primary residence. I was a married couple. I had capital improvements. And then you can get the whole thing back if that's what you were owed. So let me talk to you about the best ways to handle this, right? The first thing you need to do if you're going to sell a house is let the settlement company know you're planning on doing it. We can have you fill out forms so that you don't give any money to the IRS off the top to withhold. Instead, it gets held by the settlement company. For how long? About 90 days. Settlement company will not send it to the IRS. They'll hold it in escrow for 90 days till they get all the paperwork, and then they give it back to you. So that's a much better solution than giving it to the IRS, filing taxes, and hoping to get it all back the next year. So that's what you want to do right at the beginning. And so you won't have to worry about sending anything to the IRS. Then we look down at how much is withheld. Well, if the sales price on the property is less than $300,000, then it's zero. So you don't even have to worry about filling out that paperwork anyway. If the sales price is between $300,000 and $1 million, it's 10% off the top. So if the house is being sold for $800,000, they're going to hold $80,000. It's a lot of money, right? So you want to have that held in escrow with the settlement company and get it in 90 days, not try to get it back from the IRS the next year. And if the house is being sold for over $1 million, it's 15%. So same thing. If the house is sold for over 300, whether it's 301 or 3 million, fill out the paperwork first. You'll get your full sales net proceeds much quicker that way. Okay. The next couple of slides, I'm going to talk a little bit about what's going on in the market right now. And it's been a very interesting time in the real estate market, to say the least, because we all know in March of 2020, the pandemic happened, which is why we're on Zoom right now. And at the start of this with the real estate market, there was a lot of questions. Oh my gosh, what's going to happen? Is the market going to do poorly? Is it going to have an impact? Nobody really knew. Well, as it turned out, the market's done extremely well. Now, the interest rates have been extremely low, and that's always helpful for the market, but it seems as if the market's done extremely well in the pandemic. These two slides, this one here and the next one, are very broad slides. And I'm really talking about, you can see here, it's called the Mid-Atlantic region. So I would be happy if anybody emails me afterwards and they want to know what's kind of going on in their neighborhood. I'm happy to sort of dive into that for you. But since I have lots of people on this presentation living in different areas in different states, I'm not able to tune into any one person. But as you can see, the market's done extremely well. Some key things to look at on this summary. We can see the median sales price from a year ago is up from 310,000 to 350,000. The average price is up from 378,000 to 433,000. All of these numbers, and one I want to point to you also, I should have the days on the market. Yes, the average days on the market, you can see, is way down. 43 days on the market was average a year ago. Now it's only 22 days. So that is really a sign of a strong, healthy real estate market. One thing I want to point out to you here that's very, very important. As you go down, it's sort of broken up here between attached and detached, right? But I almost think a better way to break this up is because an attached home could be a townhouse, but I more associate townhome sales with single family detached home sales versus condo and co-op sales. Because the truth is, and I can tell you this firsthand because I deal with this every day, the townhouse and single family detached home sales have done extremely well during the pandemic, whereas the condo and the co-op sales have lagged behind quite a bit. Not that they haven't done fairly well, but not nearly as well during the pandemic. And there's probably a lot of reasons to that are beyond interest rates and things of that sort. It just could be that there's been a little bit less allure to living downtown and a little more attraction to having a little more space as we all sort of live and work from home and commute a little bit less. That is possibly something in 2022 that could kind of come back and change very easily. But I would like to mention that out because that isn't as clear in the way it's broken up here, but I can tell you that's a little bit true too. Now, on this next slide, it brings up something very interesting to me, as you see here, and then I have sort of blown up here on the left of the slide. So we see all these big increases, right? We see literally a 10% jump in a year, which is incredible, right? In the market. You can see that right here, and then you can see that again over here from 2019 to 2020 and 2020 to 21. So sort of two big jumps there. But then if we just look at a month ago, there was a drop of 1.5%. Even now, it's still with that drop up 10.2% overall, but there was a drop of just about 1%. And it's an interesting thing. Why is that? What does that mean? Well, honestly, it could mean a little flattening of the market, which is really healthy and due from all of the bidding wars and things that have happened in the last 3, 6, and 9 months. So it could be a little flattening of the market. It's something that sometimes happens this time of the year, frankly. You all may have heard of the spring market, which usually starts in March and goes through May. And some of that's just based on the school cycle, people not wanting to move in the middle of the school year. Matters more in maybe single family homes than 1-bedroom condos. But it does sort of make a difference. And it'd be interesting just for all of us to see how that plays out in the next months ahead, if that means anything, or it's just typical for sort of the fall time of the year. Okay. Let me move on to the next thing, which is just to tell you a little bit about the Smart Move program. And I'm sorry if I'm moving quickly, but I'm trying to explain everything in a concise way. And then I can take some questions after I finish up with talking about the program here. So as I mentioned at the very beginning, what I want you to do is enroll in the Smart Move program. There's a lot of benefits where we help coordinating, whether it's a move, whether it's a loan, whether it's finding your home. And then of course, there's a financial benefit too, which is sent to you, after you've completed the program and made your move. Oh, yes, one thing to note, and it's also important, is you must be a member or employee of the IDB Global Federal Credit Union. And I mention this because there are people who are, maybe you're retired and you're still a member of the IDB. Will you still be eligible? And the answer is absolutely yes. You'll be eligible. You'll be assigned a coordinator. The coordinator is not me. As a realtor, I am on the team sort of under the coordinator. So the coordinator will help you, working with me, in working with obtaining the loan. We have, whether it's moving, whether it's insurance, we have our own insurance staff involved. And so with each of these things, you'll be set up with your Smart Move coordinator for that. And then also the rebate that you'll get will be received within 30 days of closing. It usually is a check that will go out to you at your new address in the first week, truthfully, but they say 30 days just so that you will, you'll get it earlier and you won't be waiting. Where's my check? It won't happen. We don't do it at the settlement table for a reason. And the reason is that sometimes, particularly in a case where I'm working with a buyer, the rebate's good for buying and selling, but sometimes I negotiate closing costs for my clients. If they don't want to pay out of pocket, we can ask the seller to pay their closing costs for them as a credit at settlement. Well, the way lending guidelines work is you're not able to get more of a credit, if you will, than the total of your closing costs. So let's say the total of your closing costs came to $20,000 and you're already getting a credit from the seller for $15,000, you wouldn't be able to get a rebate for more than $5,000 in that case if it's paid at the settlement table. So we just put it there so you know what you're getting, and then send it to you in the mail, the very week it closes. Let me talk to you now, just so you know what that cash rebate looks like. So this is an example here on the right of something that's typical. If you were purchasing a property for $300,000 and the cooperating or buyer agency commission was 3%, we would give you a check for 20% of that, which would come to $1,800. So it really depends on the price of the property, mostly, and the amount of commission being paid, but mostly on the price. So obviously, the greater the price, the greater the cash rebate that you would get at the like I said, within 30 days of settlement, but usually it would be much quicker than that. And also on this slide, I bulleted some of the other benefits too. As I mentioned, the competitive rates for your loan and all the other services, from insurance to moving, etc. On this slide here, I know there's multiple people at the credit union. They're all wonderful. I've worked with several of them, and they can help you start the process of obtaining the pre-approval letter, which, like I said, is step one, but in this case, it's really step two after registering for the Smart Move program. And then all my information is here, and that'll be part of the slide, my mobile number and my email. So if you are interested in obtaining a more specific market evaluation for an area, whether you're looking to buy or sell, I can do that for you rather than the broader one I made for this purposes. So Marilyn, I'm ready to begin the Q&A section.
Wow, some great information, Josh. Thank you for
you.
going through that. I'm sure that our attendees learned a lot from you. Just to recap, I did put a little message in there that, if you have any questions, I don't see any yet, please put them in the Q&A bubble at the bottom.
I want to mention there's a few in the chat. I haven't looked at it. I
don't see any.
No, in the chat, but not in the Q&A. So
Yeah.
I don't know if anyone inadvertently put it in the chat.
Yeah, that was me. I don't see any in there.
Okay.
Those were my messages, but
okay.
Q&A, if anybody has any, please put them at the bottom of the screen. You'll see the two little bubbles at the bottom. We'll wait a few minutes while I go through some final housekeeping items to give you the opportunity to ask some questions to Josh while we have him here. Remember that this is recorded. So I had mentioned this at the top, but also a great reminder that we will be sending you this content, Josh's information as well, included in the slides, as well as the video. So, wait for about a week and you'll get an email from me regarding that. And then please make sure to fill out your survey. You will be getting that after this event. I do want to remind you that we have a lot of great seminars here at IDB Global Federal Credit Union. Make sure you go to idbglobalfcu.org. You'll see it under products and services, or events, actually, webinars. So take a look at that page and sign up for webinars that are coming down the pike and see what topics that we have to discuss. So I'm not going to stay too much longer, but it looks like we have a Q&A. We have a question. Thank you. Josh, if you want to take a look at it, I'll read the first one. Is it absolutely necessary to have a Social Security number to apply for a loan?
It is really, it's very difficult to obtain a loan in the US without a Social Security number. It is possible, and only the credit union and a couple other places could do it possibly, because of their international capabilities. They might have some alternative ways to look at it. But generally speaking, for example, if you went to any of the big banks, Wells Fargo, Bank of America, or even the local banks here, they would absolutely not be able to do it. The credit union at IDB would probably be your only option in being able to do that.
You can email our loan officers as well, or make an appointment online and ask them that question as well to see how they can help you out. The email cu.lending@idbglobalfcu.org. And then if you go onto our site, it says book an appointment at the top right, and you can book an appointment and ask them live. And then the second question is, what alternative do I have if I need the 10% of taxes retained to buy my next house?
Well, I'm not sure I understand. You don't need 10% of taxes to buy a house. I don't know if you're referring to just the cash as a down payment, or the tax burden is really on the sale side, not the purchase. There are closing costs on the purchase side, which are usually somewhere around the 3% range of the purchase price. And as I mentioned, there are even ways around that. For example, if you were going to buy a house, let's say for 500,000, and you needed the closing cost of 15,000 plus the 10% down of 50,000, right? We could roll the 15,000 closing into the purchase price and ask for a credit for that, so that you would not need that 15,000 closing costs out of pocket. You would have, however, need the 50,000 to put down as a down payment, because the lenders don't want to see, for example, if you were putting zero money into the house, it creates a high level of risk for the bank. And so I have strategies to avoid the closing costs to be paid out of pocket. But when getting a bank loan or a credit union loan, it's hard to avoid the actual down payment requirements, because from an underwriting guideline, they like to see you vested in the property. I can tell you this, a lot of people think 20% is sort of the gold standard, but not always a requirement. It really is just something so that you can avoid what we call private mortgage insurance, or PMI. And PMI goes away after a few years, usually, if you're putting a good down payment, like 10% down. So I don't know if that answers the question or not.
Yeah, she actually
I understood
clarified,
it.
said 10% for my down payment. So she clarified that as you were.
Oh, okay, sure. So yes, thank you. So I was on the right track with my understanding. So yeah, I can help with avoiding the excess cost of closing costs by rolling that in as a credit, and then you sort of could finance it into your mortgage. But the lender requirement, the underwriters, what their job really is to avoid risk, right? They want to know that this person is credit worthy, that they have a good, what we call debt to income ratio, and they want to know that you're putting some money into it. So there are some strategies to lessen that from 10%. And I can tell you about that sort of off, one-on-one perhaps, but very few programs, with the exception if you're a veteran in the US, you can get what's called a VA loan from the Department of Veteran Affairs, and they let our veterans do it with 0% down. So sometimes it's neat when working with veterans, because they put no money down, 100% financing. We negotiate and roll their closing costs into the loan, so they don't have any closing costs. So they literally show up with a pen and get keys to the house, which is pretty neat. But that's the only way to do it, really.
And there was one last question. Is there an advantage to pay in cash or 30 or 15-year loan?
Sure, that's a good question, and I'll answer it. First, to be fair, there's no right or wrong answer to it. It's everyone's individual situation. However, I can tell you this, I see this a lot, particularly now when interest rates are so low, that there are people who have, purchased very expensive homes, and they have a lot of money they could pay in cash, and they choose not to. And the reason why is because if they're getting interest rates at something ridiculous like 3%, it almost is, cheaper than cash. And so, your returns, are better than the amount you're paying on an interest. Plus you get, in some cases, depending on how you file taxes, if you pay income tax here, you can write off some of the interest that you pay every year too as a tax deduction. So there are a lot of reasons why people who could pay cash choose not to, because there's some financial incentives, where low interest rates and mortgage interest tax deductions actually make better sense.
That's great information. And also you can ask our loan officers as well, and they can provide you options. And actually, there's more questions coming in, so this is great.
Okay.
Does the IRS require any specific documentation to prove my expenses in a house in order to consider it as capital improvement?
Not really. No, it's a form that you fill out, right? And you can keep, if you need to keep receipts or anything like of that nature, but it's just a standard IRS tax form that you'll fill out and you'll list your capital improvements. It's not that unlike when you file your taxes. I don't know if you've ever taken write-offs. I know a lot of people at the IDB might be W-2 salaried employees, but so for example, I'm a 1090, I get a 1040 and then I file a 1099. So I have a lot of line items. And so, you know, unless I was say to get audited or something, and then they'd want to see receipts for things, but it's pretty standard. So to be able to write off capital improvements. So the idea of avoiding capital gains, right, and is to step through it is one, notify the realtor and the settlement company, hey, can I fill out a form at the beginning? So that way, any money I escrow just gets held by the settlement company for 90 days, right? Rather than off the top. Then based on who owns the property, is it me and a spouse, that I'm exempt for $500,000 right there. And then capital improvements, I cut down my my tax burden right from there. And then I'll get everything back in 90 days from the settlement company from their escrow account. And it won't even go to the IRS. That's really the best way to do it. But if you did have to go to the IRS, then no, it's standard forms. You'll probably get it all back anyway, but it might be like 9 or 12 months later. So that's why I'm saying let the settlement companies escrow it rather than dealing with the IRS.
Okay, we're going to take one more question, just one quick follow-up before we sign off. This is a follow-up to your other response where you were talking about cash or 30 or 15 year. They just want to know real quick, in a bidding war, what is the best? Is there a better option? Does it matter? You know, the form
Sure, that's a good question. So I'm sorry, is the question if you're buying a home, what's most attractive in making an offer in terms of your financing? Is that right?
I think it's also related to a bidding war. So if they're
right,
bidding, yeah.
Sure. Okay, that's a good question, because in 2021 there's been a ton of bidding wars. I can tell you personally, I've been involved in, I don't know how many, several, as a listing agent and as a buyer's agent. So yes, if you are in a multiple offer situation where you want to buy a house and this house just came on the market a few days ago and the listing agent says there's an offer deadline of 12 noon on Tuesday, we're accepting offers, and you know there's going to be 5 offers, there's going to be 8 offers, there's going to be more. Well, what you might need to do in that situation is a few different things, and I'll try to be brief about it. One is you want to make your offer what we call as clean as possible. And what I mean by that is I talked earlier in the slide with the ring, the circle, about all the different steps to buying a home and all your contingencies. So what you want to do is eliminate as many as you can by making it clean, saying, okay, I'm going to do a pre-offer inspection. You know, I'll spend a few $100s. I'll get it inspected before I make my offer. I know the house is in good shape then, and I can make an offer, and I don't have an inspection contingency. I'm offering cash, so there's no appraisal or financing contingency, right? And here it is. So that's the cleanest offer in the world you can make, right? So certainly that's the best. Now, let's say you don't have the cash, but you're very confident in your loan, or you have the cash and you want to spend it. You're very confident in your loan. You're saying, okay, I'm going to waive my contingencies anyway. I'm not worried about appraisal, because the truth is, if the house is, say, $600,000, if it fails to appraise, it's not going to appraise for 100. It'll appraise for 590. It'll appraise for 580. I can make up the difference in cash. I'm going to waive my appraisal. I've done a pre-offer inspection. I'm going to waive my inspection, and I'm going to waive my financing because I know I'm good for it. I'm not going to lose my job in the next 3 weeks. And a lot of people do that, and they're saying, hey, I'm not offering you cash, but I'm offering you a loan. Here's my pre-approval, and I've waived all my contingencies, and that's about the next best thing. Yes, still cash is the best, because you're saying, hey, here's my money in the bank, and you don't have to worry about anything. So in a multiple offer situation, I guess the answer is the cleaner you can make it, the better, starting with cash, going down to no contingencies, and then going down from there.
Post-COVID, the market appeared to be in a state of deals closing at 20, 30, 50, even 100K over what it is, or as is, asking as is.
Yeah.
Does this happen often? And does it happen in the DMV area? And has it quieted down? What is your expectation for 2020?
Well, as I showed in that one slide, which was interesting, the second of the two about pricing, where twice in the last 2 years, we had these incredible jumps of 10%, right? And then in the last month, we went down just 1.5%, right? So what does that mean? Is it a cooling off of the market? The market boomed during COVID, as I mentioned, not as much for condos and co-ops as single family homes, although they've both done well. Townhomes I would put with the single family homes too. But the fall is not as hot a market normally, so it could just be a normal cooling out in September, or it could mean a little bit of a shift where we've had these 2 great years. We didn't know what to expect at the start of the pandemic. We've had this incredible increase, and it'll be interesting to see what happens in the next few months, because we just saw a month of cooling off. And is that a new trend, or is it going to pick back up again? We'll have to see. But one thing I can say is it seems that interest rates are remaining incredibly low for the time being. And often that's as big a factor as anything else, because most buyers, sort of like when you buy a car, you know what you're going to spend and you negotiate your monthly expenditure. And the banks look at that on the back end when they approve your loan in the same way. So if the interest rates stay low, your payments are going to be the same, and it will get you more sales price in the home.
That's great. And actually, we just dropped our fixed rate mortgage rates. So take a look at that as well. And then last question, I promise. If you sell what is your principal residence after you leave the United States, and instead of being withheld, the proceeds of the sale go to an escrow for 90 days, what happens? What needs to happen to have said funds released within that period?
All you need to do is give the documents to the settlement company. That's why they'll have you fill out a form in advance, and they'll probably collect out a lot of them at that time. So by the time you actually go to settlement, hopefully all of those documents and forms will already be done, and the settlement company just needs to wait the 90 days and release your funds. So it's a much easier process. But if you don't fill out the forms and give them the documents that you need at the beginning, by the time your property is already under contract, it's too late, right? And then the settlement company will say, hey, we've got to go through the IRS, and then you have to file and get them back the next year.
Wonderful.
But if you do it in advance with the settlement company, they'll collect everything that they need, and then the answer should be, you should be done even before the house is under contract. It's just a waiting period.
Wonderful. Everybody, thank you for your questions. Josh, thank you as always for being so informative. I will be providing Josh's information as well, so that way you can get in contact with him after this event. So I wish everyone the best of luck in their home buying journey, and we'll see you soon. Have a great day, everybody.